Hi, this is James Shugg with the end of day markets report for Thursday, the 1st of September. Okay, it started off in Europe with some disappointing numbers on the German economy. We saw a downward revision to the Euroland factory PMI, most of it concentrated in the German subcomponent of that. And also, although German GDP growth in the second quarter was unrevised at 0.1%, the detail that was published in today's follow-up report showed that consumer spending or consumption spending fell 0.7%, which matched a very steep fall, which matches the steepest quarterly fall in consumption that we saw right through the recession of 2008 and 2009. There was also a sharp slowdown in business equipment spending as well. So disappointing German numbers have meant that the DAX, the German stock market, has actually underperformed most of the European markets today. The DAX is down 0.9%, whereas there's small gains of 0.3% up in France and 0.4% higher in the FTSE, just heading into the close. It's just before 5 o'clock at the moment here in London. We moved on to the US session. There we saw the release of a whole range of economic data. I won't run through all the bits and pieces. Probably the main one was the US ISM manufacturing survey for August. This is a national survey. We've seen many weak regional factory surveys for August. The ISM national had been expected to dip below 50 for the first time since the recession. It didn't. It eased slightly from 50.9 to 50.6, still quite soft. The production component contracted, the orders component contracted again for 2 months running now. Employment was weaker. The supplier delivery times were more or less unchanged, and the fifth factor that drives the headline, inventories, actually rose from sub 50 to above 50, a 3-point rise. So that actually added 0.6 to the overall ISM. That is, it would have fallen to 50, which basically means stalled activity, rather than the nearly stalled activity that the 50.6 reading we actually got implies. Now, the stock market has actually initially spiked higher on the ISM, but then lost that momentum, that upward momentum, and actually gave up a 100-point gain as analysts looked more closely at the detail and saw that actually it was pretty soft. And if it wasn't for that inventories number, it would have been weaker. One other interpretation could be, I suppose, that given that it was a stronger headline, maybe some investors thought, well, that means less chance of further Fed easing, so we'll sell stocks for that reason. You can put any sort of spin on it, but the point is it's still a pretty weak report. And it was actually it was accompanied by figures on construction spending for July, which fell very sharply after 3 monthly gains in the previous 3 months. That's an important point, because one of the components of our very weak payrolls forecast, that's for the monthly jobs report for the US coming out tomorrow, is that we think the construction spending, which spiked a bit in July, will fall in August. And so to the extent that any firings related to that pullback in construction spending, which is right across the board, public, private, residential, non-res, to the extent that any firings that were part of that occurred after the payroll survey week for July, they'll be captured in the August survey. So another little piece of weak evidence, weak data that supports our view that we're going to see a soft jobs report tomorrow. Other data worth noting, no, they're probably the main ones. The other one I'll mention quickly is weekly initial jobless claims, a measure of the extent to which people are being laid off in the US, fell 12,000 to 409,000 in the latest week. But that decline simply reflected the fact that there was a spike in claims related to a Verizon strike that's now been largely resolved. So the underlying trend in claims is pretty much unchanged, suggesting that there's a fairly steady pace of layoffs going on in the US. So if the labour market really is deteriorating like we think, it's deteriorating because firms are hiring fewer people. And actually, speaking of the labour force numbers coming up tomorrow for the US, we're expecting a 20,000 increase. The reality probably is that the US is actually shedding jobs at the moment, but there's an upward bias in the payroll survey at the moment because of the way the statistician treats the employees of newly created firms. This recovery is very different to previous recoveries. The housing market's not participating. There's a lot less consumer spending going on because of that. And that means, we think, that the business births that the BLS thinks are happening and makes adjustments to the bottom line figures for actually aren't happening. And so there's a permanent overstatement in payrolls. The household survey of employment That's only shown a 90,000 increase in jobs in America this year so far. The payroll survey has shown 930,000 jobs. Okay, so at some point soon we should see a bit of a correction lower, we think, in that. We might see part of it in the August numbers tomorrow. We might get a greater indication of that in the September figures when we get an early hint as to what the likely benchmark revision to previous numbers is going to be. So that's just a bit of background on the jobs numbers. Even if we do get a surprise spike in payrolls tomorrow, I wouldn't believe it. Okay, we're looking for the unemployment rate to pick up to 9.2% as well. There were some other factors that boosted the July payrolls numbers related to the auto sector and the electronic sectors, which we think will reverse in August as well. And you've got to watch out for the impact of the Verizon strike too. A bit hard to say exactly how it's going to impact on the figure but we should have a guide from the statistician once we've got the figures as to what component of that or what part of that payrolls number actually was related to that one-off strike, which has since been resolved. Anyway, moving on to commodity markets today. A few gains there to report. We've got oil prices, well, up 0.1%. That's not too much, really, is it? $88.90 a barrel. Gold is down a third of a percent, very minor change there, $1,825 an ounce, and copper's down 1.4%, reversing yesterday's gain. The Aussie dollar, however, is doing okay. It's at 1.074 against the US dollar, grinding higher as I speak. Had a bit of a lift yesterday, or last night, I should say, my time, yesterday your time, from the decent enough retail and capex numbers, capital business and investment spending numbers that were released, and it's also benefited a bit from a bit of US dollar weakness that's been creeping through, at least against some currencies today. Okay, look, I'll leave it there, but we'll be back with a biggie tomorrow when we'll report on the jobs report for the US, the most closely watched financial market indicator in the world, even though it's probably the least accurate measure of what's actually going on in the US labour market. And perhaps I'll talk a bit more about that conundrum tomorrow.